Hello friends, good morning. So this is our third last session of income tax. Let us revise the things that we have done till this point, then go to filing of income tax returns. About 74 pages topic in your module, that is filing of returns. It has miscellaneous things like the due date of filing of return, which you already know, then revised return, something called as belated return, defective return, all these things. Apart from that, requirement of having PAN, that is permanent account number, linking of Aadhaar and PAN, in which cases it is mandatory to quote your PAN, and in which cases ITR filing is compulsory. Who will verify that income tax return? All these things are there in the topic of provisions for filing, return of income and self-assessment. Very simple topic. But before going to that, let us revise what we have done till date in income tax. So technically, the whole income tax starts with residential status. Residential status is heart and soul because based on whether you are resident, resident, not ordinary resident or non-resident, it decides what income will be taxed in your hands in India. For example, if it is income which is received in India means bank account is in India. So there could be a non-resident also, but who is maintaining bank account in India. Then what will happen? The income will get taxable in his hands if it is received in that bank account in India. So what have you seen of income received in India? Taxable, taxable, taxable. ROR, NOR, NR. Income arising in India. Arising in India means source of income is in India. I told you more of this you will learn at final level, section 9 actually. Means which income we can say is arising in India or deemed to arise in India or accrue in India. So taxable, taxable, taxable because source of income is in India. And third, income which is neither arising in India nor received in India, but it is out of a business or profession which is controlled from India. If it is controlled from India, then it is taxable, taxable, not taxable. So additional person in whose hands it becomes taxable is R, NOR. In NR's hand it is not taxable. And lastly, nothing is happening in India. It is neither arising in India nor received in India, nor it is from business or profession controlled from India. So still one person will always pay tax, that is ROR. Okay. So taxable, not taxable, not taxable. And finally, nothing is happening in India or whatever income is foreign income, but it is not of this year, it is a past foreign income. What will you do with past foreign income? They might say, huh, it is untaxed. They might say it is untaxed. Past foreign untaxed income now remitted to India. They might say that. But it is not taxable in either of the cases because it is not income of this particular previous year. So this is about your residential status. Scope of income. Scope of income section 5 can also be called as incidence of tax. Okay. So in short, there are some additional clauses which declare Indian citizen or person of Indian origin as RNOR. If he is declared that, then only one thing can happen. If the business is controlled from India or profession is controlled from India, then his income will become taxable. Okay. Then secondly, how to decide whether individual is what? Resident, non-resident? How to decide? So you should check basic conditions. How many basic conditions are there? Two. In that you don't go to second basic condition. If you are Indian citizen, you don't go to second basic condition. Only check first. What is first? 182 days or more is the stay in India during the previous year. And second basic condition which should be checked for foreign citizen, so not to be checked for Indian citizen, that is his stay in India during the previous year is 60 days or more, and in last 4 years it is 365 days or more. Now if any one of the two condition is satisfied, then he becomes resident, and if both additional conditions are satisfied, he becomes resident and ordinary resident. So what are the two additional conditions? His stay in India during last 7 years is 730 days or more. So see, simple to remember 730. And in last 10 years, he is in India, he is resident in India for at least 2 years. That's it. So he will become ROR, like you have seen yesterday in one of the MCQ. That person became ROR. And what you have learnt yesterday, that don't take decisions only by sixth sense. Properly do the day-wise calculation and take the decision. But Indian government thought of broadening. Broadening what? Broadening the provisions to call individual as RNOR. So how they have broadened the provisions? They have broadened the provisions by inserting some clauses. In those clauses it is given that Indian citizen or person of Indian origin will be called as RNOR if we stay in India during the previous year is 60 days or more, 120 days or more, and in last 4 years 365 days or more, plus his Indian income is exceeding 15 lakhs. But anyways, for Indian citizen, even if number of days stay is not satisfied, still it is okay if his income is exceeding 15 lakh and he does not have any foreign income. Foreign income means based on domicile. He does not have any foreign income. Based on domicile means he is not resident of any other country, okay, because of which he is getting the income. So all these things we have learnt in residential status. Okay, then after that, once you decide residential status, actually whole syllabus we did assuming that assessees are OR. And anyways, you will understand it doesn't matter with respect to calculating income if you are in India, especially if you are ROR or NR or RNOR, the way of calculating income remains same. So there are 5 heads of income: salary, house property, profits gains from business profession, capital gain, and income from other sources. 15, 22, 28, 45, 56. These are the charging sections. Employer-employee relationship. Whatever is earned by way of relationship of employer-employee is taxable under the head salaries. Annual value of property owned by the assessee. House property. Profits gains from business profession, PGBP. On transfer of capital asset under the head capital gains, on transfer of capital asset. And lastly, some specific incomes taxed under the head IFOS. Apart from that, whatever incomes which could not be taxed in first 4 heads are taxed under the head of IFOS. This way you had the 5 heads. Now salary is how to calculate. See, first day we had done a detailed format. Now again, just trying to recollect that. See if it has a better understanding now. You have to find GTS. From GTS you have to take deductions of section 16. 1A standard deduction. Standard deduction when I am in 115 BAC, then it is 75,000. If I am out of 115 BAC, 50,000. Profession tax. Profession tax is actually subsection 3. Profession tax is allowed to the extent it is paid, but allowed only when I am out of 115 BAC. And profession tax, and then entertainment allowance, again allowed only when I am out of 115 BAC, allowed only for government employee, allowed to the extent of 20% of basic salary or rupees 5,000 per annum, or of course the actual entertainment allowance received, whichever is less. So entertainment allowance will first form part of GTS and then deduction will be given, not GTI, GTS, and then deduction will be given. Okay. Then what all forms part of GTS? What all forms part of GTS? So basically all monetary benefits, all taxable value of perquisites, then all taxable allowances, then SPF, RPF, UPF, employer's contribution and interest credited to SPF, RPF, UPF. That forms part of your GTS, gross taxable salary. What are the important allowances which get exemption? Because no need to discuss basic, bonus, commission, because basic, bonus, commission, incentives, any other monetary benefits are always fully taxable. So no point in discussing them. Allowances, some important allowances which get exemptions are HRA, children education, hostel expenditure. Now children education, hostel expenditure, amounts may not be big, but still from exam perspective they are important. 100 rupees and 300 rupees respectively per month per child to the extent of 2 children. But one thing remember, HRA, children education, hostel expenditure will be allowed as exemption only when I am out of section 115 BAC. HRA exemption is actual HRA received rent paid minus 10% of salary, 40 or 50% of salary, where salary is equal to basic plus DA terms of employment plus commission percentage of sales, and 50% is in case the rent is paid in Mumbai, Delhi, Chennai, Kolkata. Done? Understood? Then transport allowance is allowed as exemption only for handicapped employee to the extent of 3,200 per month, and it is irrespective whether I am in 115 BAC or I am out of 115 BAC. Clear? Then taxable perquisites, but there are some tax free perquisites. For tax free perquisites, valuation will be always nil. For taxable perquisites, you will have to do the valuation. Important taxable perquisites are accommodation, interest free or concessional loan, then transfer of asset, use of asset. What you are saying, laptop. Laptop is a tax free perquisite. Use of laptop is a tax free perquisite. Okay. See, some tax free perquisites are use of laptop, medical insurance premium of employee paid by employer, then telephone facility, subsidized meal up to rupees 50 each meal. 2 meals per day. But one thing, this is allowed. This is a tax-free perquisite only if you are out of 115 BAC. Then education facility up to rupees 200, up to rupees 100, 1000. Education facility where the cost of education is up to 1000 per month per child. Clear? Then gift in kind up to rupees 5,000 per annum. There are two interpretations in this. You can either tax entire amount if it exceeds 5,000, or you can subtract first 5,000. So these are all about tax-free perquisites. Taxable perquisites, motor car is also there. Motor cars valuation depends on CC. Accommodations valuation depends on population if it is owned by employer. If accommodation is taken on rent by employer, then actual rent paid or 10% of salary, whichever is lower. Now, point is the accommodation could be furnished or it could be unfurnished. If it is furnished, you add the value of furniture also. Value of furniture is 10% per annum of original cost of the asset. But if the furniture is taken on rent by the employer, then actual rent paid by the employer. But this furniture and this whole accommodation could be rent free or it could be concessional. If accommodation is concessional, then you subtract rent recovered from employee, if any. Correct. So that gives you value of concessional, furnished or unfurnished accommodation as the case may be. Now, one more thing. when I talk about interest-free loan, then the benchmark rate of interest is to be taken of SBI. SBI, RBI no. RBI doesn't give loan to anyone. RBI is banker of banks. So I want largest public sector bank, which is SBI, and I want SBI's rate of interest for the loan, similar loans, as on 1st April of the PY. So we are discussing with you for PY 24-25, AY 25-26. So we want as on 1st April 2024. Okay. What you have to do? You have to check what is the maximum amount outstanding at the end of the month. So maximum amount outstanding at the end of the month multiplied by the rate of interest of SBI as on first day of the PY multiplied by 1 by 12. So you get for that particular month. But you know, if for many months in a year outstanding amount is same, then you can directly do the calculation. For example, amount outstanding on 1st April was say 10 lakhs and it remains 10 lakhs throughout the year. Then you just do 10 lakh multiplied by rate of interest of that SBI. If some amount is recovered from employee, then what you have to do? You have to minus. Suppose rate of interest charged by SBI would have been 10%, but charged by employer from employee is say 3%. Then you will calculate the value of perquisite at 7%. This will be called as value of concessional loan. So this is your topic of salaries. Apart from that, in salaries, retirement benefits you should do properly. Retirement benefits means leave encashment, gratuity and pension. You know their exemptions. Gratuity, when received while still in employment, it is fully taxable. But received at time of retirement will get exempt. You know what is the exemption? If received at time of retirement by government employee, it is fully exempt. By other than government employee, two possibilities: covered by payment of gratuity act, not covered by payment of gratuity act. Leave encashment exemption shall be least of 4. That too when received at time of retirement. That too by other than government employee, because received by government employee on retirement is fully exempt. And then pension, uncommuted pension and commuted pension, but not family pension, because family pension will be taxed under the head IFRS. We are talking about pension received from former employer, because there is an employer-employee relation. So uncommuted pension means one which is received on per month basis, that is fully taxable, and you can take standard deduction of 50,000 / 75,000, because eventually it is getting taxed under the head salaries. Commuted pension, when received by government employee, fully exempt. But other than government employee, two possibilities: you are receiving gratuity also, you are not receiving gratuity. If you are receiving gratuity, then 1/3 of such pension had you commuted 100%. If you are not receiving gratuity, then half of such pension had you commuted 100%. Simple. Getting it? Then after this, if we talk about that PF, SPF, RPF, UPF, which is the best PF? SPF is the best PF. Why SPF is the best PF? Employer's contribution is exempt. Employee's contribution allowed as deduction under section 80C. But you know when you are opting out of 115 BAC, and then interest credited, fully exempt. Amount received on maturity, fully exempt. So SPF is best. Worst is UPF. Why is UPF worst? UPF is worst because what happens? UPF is worst because employer's contribution is exempt, employer's contribution not allowed as deduction, interest received on year to year basis is again exempt, but amount received on maturity is fully taxable. So very danger. Amount received on maturity is fully taxable. How is it fully taxable? The employer's contribution is taxed under the head salaries, but employee's contribution is again not taxable because your own amount you are getting back. Interest on employer's contribution is taxed under salaries. Interest on employees contribution is taxed under the head IFOS. Okay, and RPF is mid. Why RPF is mid? Employer's contribution is exempt but up to 12% of salary. Employee's contribution allowed as deduction under section 80C. Interest credited to RPF is exempt up to 9.5% of the principal amount. So whatever percentage it is given, say at 12% it is 1,20,000. It is given at 12%. Exempt will be at 9.5%. So you have to do the cross multiplication and calculate. You will not be given principal amount. You will be given that at so and so percent, so much is paid. You have to exempt at 9.5%. Unitary method. Going to house property. Gross annual value minus municipal taxes paid by owner of the property during the PY, NEV, net annual value, less standard deduction at 30% of NAV, and B, interest on borrowed capital. Makes sense? So see, standard deduction is okay, 30% of NAV. Interest on borrowed capital allowed without any limit if the property is LO or DLO. But if the property is self-occupied, there are ceiling limits. Those ceiling limits are, if the loan is for repairs and renewals, it is 30,000 per annum. But if the loan is for construction or purchase, it depends on the date of the loan. If date of the loan is prior to 1/4/1999, then it is 30,000. If loan is on or after 1/4/1999, it is rupees 2 lakhs. But things to be understood is that this is per assessee, not per house. And for self-occupied property, interest on borrowed capital is allowed only if you are going out of 115 BAC. One more point now, since we are doing analysis, you will understand. Income from HP, means loss from HP, can be set off against other heads of income only to the extent of rupees 2 lakhs. Mind you, someone is saying it can be set off only against salary. No, income from HP can be set off against salary also, PGBP also, capital gain also, IFOS also. In our sums, it did happen most of the times that we set off against salary. Not necessary, but it can be set off against anything. Clear? Now, one more thing. So, how many HPs can be shown as self-occupied? Any two at the option of the assessee. Others will be DLO if they are not actually LO. For DLO property, GAV will be equal to RER, reasonable expected rent. Because usually how you find out GAV? Usually you find out GAV as municipal value, fair rent, whichever is higher, it will be compared with standard rent, whichever is lower, it will be called as reasonable expected rent, or your institute can also call it as expected rent. It's fine. Reasonable word they may not say. So reasonable expected rent will be compared with annual rent, and you have to take whichever is higher as GAV. But annual rent should be subtracted to the extent of unrealized rent, if any. But unrealized rent can be subtracted only if conditions of Rule 4 are satisfied. Means it's the bona fide tenancy, then that tenant is not occupying any other premises of yours. You have instituted legal proceedings against him. If you have not instituted legal proceedings, you should ensure that instituting legal proceedings will be useless. I am not using word useless. Rule 4 is using the word useless. Okay. So these 4 conditions of Rule 4 should be satisfied. Then only I can minus unrealized rent. Then if there is any vacancy, then that vacancy should be subtracted. And then you will get GAV after considering vacancy. Then after this, what I want to understand is, if unrealized rent or arrears of rent are received subsequently, then it becomes taxable under the head HP, like you have seen in yesterday's example. there was some amount received from the house which was earlier owned, and there was some arrears of rent received. It became taxable under the head HP, and the deduction was allowed to the extent of 30%. Remembered? Yes. Then few more things I have to tell you, that is this pre-construction period interest. You remember pre-construction period interest? Pre-construction means from the date of taking loan, from the date of taking loan till 31st March preceding the PY in which house got completed. That is called as pre-construction period. This pre-construction period interest is allowed as deduction in 5 equal annual installments beginning with the PY in which construction got completed. Remember this point? Then understood. So in the 5 years, you will be allowed pre-construction period interest plus current year interest. But of course, if your property is self-occupied, then this sum total cannot exceed 2 lakhs, as we discussed. So far, so good. Able to recollect with at least 80-90%. Very good. Because tomorrow you have exam, no? So I am revising. There is a discussion going on. Should we keep exam tomorrow? Post 1 o'clock. Let's see. Don't take tension. Third, PGBP, profits and gains from business or profession. When I talk about PGBP, the most simple thing to do is how to calculate PGBP. Start with NP. Add what? All expenses which are debited but not allowed as deductions slash specific disallowances slash deemed incomes. Deemed income means there was some bad debt earlier written off, but now we have received amount, deemed income. Or there is a cessation of some liability, means liability has stopped to exist. Trading liability has stopped to exist, means it's your deemed income. But what are the other common items that you should add back? Depreciation debited. Why you should add back? Because it will be allowed separately as per IT Act. Okay, now what else you should add back? Any type of personal expense, any type of municipal taxes or such expenses which are not to be considered under the head PGBP. You should add back life insurance premium, drawings, household expense, traveling expenses which are personal in nature. All such amounts you should keep on adding back. Provision for bad debts. Apart from that, some technical things that you should add back. If you are paying for any expenses in excess of rupees 10,000 on a single day to a single person, 48.3 you should, yes, in cash you should add back. And same limit when you are paying to transporter is 35,000. This has got exceptions given in rule 6 DD. Secondly, you should add back any excessive amount paid to relatives. 40A2B. You should add back any amount that you are paying but without doing TDS. When you are paying to resident person but you are not doing any TDS and you are liable to do TDS but you did not do TDS, then 30% of the such expense should be disallowed, means added back. One more thing that will attract this disallowance is that you are deducting TDS during the PY but not depositing on or before due date of filing ITR. But 40AIA is a temporary disallowance, because in future if you do good your mistake, means if you rectify your mistake by deducting tax at source and depositing, then you will be allowed as deduction that 30% which was earlier disallowed in that PY in which you have actually deposited. Getting the point? Making sense? Then you should add back some expenses which are not paying up to due date of filing ITR. Some amounts which are not paying up to due date of filing ITR, like statutory dues, like amount payable to Indian Railways for use of their assets, interest payable to banks, financial institutions, and certain amounts payable to employees, like bonus, leave encashment, employers' contribution to various funds. If you are not paying them within due date of section 139(1), you should add it back. And if you are liable to make some payment to MSMEs, medium small enterprise, micro medium small enterprise, but you are not making payment within the due date as mentioned in that contract with MSME, then you will again add it back. This is about your 43B, but this is also temporary disallowance. In future, when you again make payment, then this deduction will be allowed. Make sense? What next? Then this you added back, this total you took in second column. In NP you added these things. You got what? Subtotal. Then you do minus. Minus what? Items which are credited but not taxable under this head slash specific allowances. What all have you credited but which is not taxable in this head slash what are the specific allowances, like rent received from HP, dividend income, interest on savings, interest on FD, interest on RD, gift received, from family, from friends, agricultural income, because agricultural income is exempt. Okay, so all these things you should minus. Depreciation as per IT Act. When you do that, take total of minus from subtotal, you minus this less figure, you will get PGBP. But friends, how to calculate that depreciation of section 32? So it is to be calculated on WDV basis. WDV of not individual asset, WDV of block of asset. How to calculate that WDV? Opening WDV, add additions, add actual cost. Actual cost means what? Actual cost means if you have got any subsidy, minus it. If you have taken ITC of GST amount, minus it. If you have paid any interest on loan till the date that capital asset came into use, add it. All this is what called as what? Actual cost. Apart from that, if you have paid any amount in excess of 10,000 in cash, please don't include it. This is actual cost. So opening WDV, add additions at actual cost, subtotal less sale proceeds of assets from the block sold during the PY. Now you got WDV. On WDV take depreciation as mentioned at rates in rule 5. Rule 5 rates will revise, but before that understand whatever is purchased during the year and put to use for less than 180 days, put to use, not owned, put to use for less than 180 days, depreciation will be at half of normal, and on balance WDV it will be at normal rates, and then you will get depreciation. That depreciation you should minus while computing PGBP. Further, that depreciation will also get minus from this block, so that you will get next year's opening WDV. Yes, if it's a manufacturing unit which has not opted for 115 BSc, it is opting to shift out of 115 BSc, then additional depreciation is possible on new plant and machine at 20% of actual cost. But if it is put to use for less than 180 days, then 10% in this year, balance 10% in next year. That's it. Of course, this additional depreciation will also get subtracted from WDV for calculating next year's opening, and it will also get subtracted from NP while computing PGBP. Then what are the percentages of depreciation various blocks? Plant and machine, general 15, motor car 15, motor car 15. Okay, computers 40%, books 40%, intangible assets 25%, other than goodwill. Correct, land, goodwill are non-depreciable. Buildings 10%, but buildings used as guest house 5%. Buildings used as guest house 5%. Then pollution control equipment 40%. This way I hope you have understood this. Then 35 AD deduction for specified business, again allowed only if you are out of 115 BSc. 35 AD, I hope you remember. 35 AD allowed for 14 specified businesses with respect to capital expenditure, with respect to only capital expenditure other than on land, goodwill, financial instruments. Whatever capex you have incurred prior to commencement of business, that also will be allowed as deduction from the date you commence the business, but provided you have capitalized in the books of accounts. Okay, there will be loss from specified business because heavy deduction you are taking. This loss will be carried forward. Set off, first of all, set off against only income from specified business. If it cannot be set off, it will be carried forward. Such carry forward is possible for unlimited number of years. Remember this session number. Whenever you have nothing to do, whenever you are traveling in a bus, just put it on the audio mode and keep on listening. Same thing, GST I have revised in 70 minutes. That also you can put on the audio mode, put the headphones, keep on revising. Instead of scrolling the reels, do this. Automatically everything gets revised. Then, going ahead, 35 AD understood. 35 scientific research. What happens in scientific research? In-house research and contribution to outsiders. That contribution to outsiders part gets deduction only and only if you are opting out of 115 BAC. Contribution to outsiders includes donation, or you can say contribution to IITs, contribution to institutions which are approved for the purpose of scientific research, contribution to Indian company whose main object is scientific research, and even research in social sciences and statistical research. Clear? When in-house research I am discussing, it will get deduction even if I am in 115 BSc. It's your own expense. It will get deduction even if you are in 115 BSc, except expense on land. Otherwise, revenue and capex both will get deduction of 100%. For contribution to outsiders also you are getting deduction of 100%. Then 37, general deductions. General deductions are allowed for any revenue expense that you do in business. It should not be capital expense. It should not be personal. It should be in relation to the business. It should be incurred during the PY. All these things are to be satisfied. But it should not be advertisement to political parties in their journals. That is not allowed. And CSR expense, corporate social responsibility expenses, not allowed. This is your 37. Then friends, 40 small b. 40 small b special. Special for whom? It is special for partnership firms. So partnership firms pay interest on partners' capital, which is allowed as deduction to the extent of 12% per annum. But it should be as per partnership deed. And then talking about the amendment part, remuneration to partners, allowed only to dash partners, allowed only to working partners. Yes, allowed only to working partners. Friends, when I talk about working partners, you know who they are, and it should be as per partnership deed. So allowed will be, to make long story short, lower of 2. What you are debiting towards working partners means what you are allowing in books of accounts towards working partners, or ceiling limit. Ceiling limit depends on book profits. If book profit is negative, means even if there is loss, allowed will be still 3 lakhs. If there is profit, but profit is up to 6 lakh, then allowed will be 90% of that book profits or 3 lakhs, whichever is higher. If book profit is exceeding 6 lakh, then on first 6 lakh at 90%, and what exceeds 6 lakhs at 60% of book profits. But what is the meaning of book profit? Book profit means PGBP, but before allowing partners remuneration. In short, it is NP, add and minus all adjustments of PGBP, add partners remuneration if debited. And I told you, if you have debited interest on partners capital in excess of 12%, that you should add back. If you have not at all debited but allowed, then you should minus. Now once you get book profits and once you get allowable remuneration, if you minus book profit, if you do book profit minus allowable remuneration, you are going to get, if you do book profit minus allowable remuneration, you are going to get PGBP. Got it? Then comes your favorite presumptive taxation. 44 AD, 44 ADA, 44 A. AD, ADA, A. AD is for those individuals, HUF, firm other than LLP, who are engaged in business and whose turnover during the PY is not exceeding rupees 2 crores. 2 crores, 2 crores. Okay, extended limit is 3 crores. But to apply this extended limit, my cash receipts should be less than 5%, or rather should not exceed 5% cash receipts. In short, 95% or more should be received in banking mode. If 44 AD is applicable, then the deemed income to be declared is 8% of turnover. But if to the extent I am receiving in banking mode, it is to the extent of 6%. Very good, fantastic. If I declare this much, no need to maintain books of accounts and no need of audit. But if I declare less than this, maintain books of accounts and get them audited under section 44 AB. Australia, Bangladesh, AB. Okay. Then, understood? If you are in 44 AD, advance tax, you will pay only in one last installment. Now makes sense? Only 15th March installment you will pay advance tax. That will be to the extent of 100% of tax payable. Okay, others have to pay advance tax in 4 installments. So in short, that 234C interest will apply to you only for last installment. If you pay, if there is any shortfall. Then 44 ADA. ADA is for assessees engaged in profession. Individual or HUF assessee engaged in profession. Okay, whose gross receipts is not exceeding rupees 50 lakhs. But extended limit is how much? Extended limit is 75 lakhs, and same condition, 95% or more you should receive by banking mode. In short, up to 5% only you can receive in cash. When 44 ADA is applicable, the deemed income to be declared is 50% of gross receipt. If you declare this much, no need to maintain books of accounts, no need to get them audited. But if you declare less than this, maintain books of accounts and get them audited. If you are following 44 ADA, if you are following 44 ADA, then you have to pay advance tax only in one installment, that is of 15th March. In both 44 AD and 44 ADA, it is to be understood that all deductions are deemed to be allowed and all disallowances are deemed to be done. So you don't have to do any additions, you don't have to do any subtractions. Whatever 8% slash 6% slash 50% we have discussed is your final PGBP. But when I talk about 44 AE, 44 A is for whom? 44 AE is for any assessee who is engaged in business of plying of goods carriages, hiring of goods carriages. Means basically he is engaged in goods carriage business. Okay, not owning more than 10 goods carriages at any point of time during the PY. Owning more, not owning more than 10 goods carriages at any point during the PY. Then deemed income to be declared depends upon the vehicles owned, ownership, not usage. It depends on ownership, not usage. Remember, na? So for heavy goods vehicle, it depends on the tons. What is heavy goods vehicle? That vehicle whose weight is exceeding 12,000 kgs. So the deemed income is rupees 1000 per month per ton. Yes, per month per ton per vehicle is 1000 rupees. Clear? If we talk about, and it's per month or part of the month by the way. If we talk about other than heavy goods vehicle, 7,500 per month or part of the month and per vehicle. For the months it is owned. So usage neglect. In 44A, once you calculate this PGBP, but if it's a partnership firm, you can take deduction of interest on partners' capital as well as partners' remuneration. This facility not allowed in AD and ADA. One more thing I want to tell you, you will have to pay advance tax in 4 installments as usual, even if you are in 44 ADA. Clear? This is about your topic of PGBP. Go to capital gains. Capital gains, I'll discuss with you the basics and the amendments. FVC, full value of consideration, minus expenditure on transfer, net sale consideration, less cost of acquisition, less cost of improvement. That gives you capital gains, minus exemptions under section 54, 54, 54C EC. That gives you taxable capital gains. Now, yes, long term, short term, what is the bifurcation? So basically 12 months, 24 months, 36 months. But this 36 months is only till 23rd July 2024. With effect from 23rd July 2024, that 36 months is also getting merged in 24 months. In short, to tell you the long story short, if I am talking about listed shares, equity oriented mutual funds, then the period of holding, if not more than 12 months, short term capital asset. For land building, unlisted shares, it is 24 months. And for other assets, it is 36 months. But I told you 36 months only till 23rd July. With effect from 23rd July, if you are selling it, you will consider 24 months for any other asset also. Then benefit of indexation issue. This benefit of indexation is cancelled actually from 23rd July 2024, but you have to remember that still available for resident assessee selling his land or building. He will get option. What option he will get? What he can do? He can, if he has transferred, see, I'll tell you, if he has transferred land building prior to 23rd July, he has to compulsorily take benefit of indexation. Of course, assuming that, I'm telling you, assuming that asset is long-term capital asset. What he has to do? He has to take benefit of indexation and pay tax at 20%. But if you are transferring with effect from 23rd July 2024, see, I'll tell you, this revision takes lot of efforts from faculty angle. Listen all provisions. At the moment I am telling you, fat, one after the other. So, utmost cooperation is required, which you are giving, but don't get deviated. Because you have high energy and you are smart, very smart, it might happen that your attention might get deviated. Don't do that. Okay. 23rd July 2024 or after that, if you sell long-term capital asset, which is which is what? Which is house or land. Then what happens? Then you have got two options. Option number one, you don't take benefit of indexation and pay tax at 12.5%, or take benefit of indexation and pay tax at 20%. You do whatever is more beneficial for you. In short, wherever tax is less. If you are transferring shares, listed shares that too, then something interesting happens. The 111A if it is short term capital gains, and 112A if it is long term capital gains. Listed shares. First, let's do short term. In short term, that means you are holding for not more than 12 months the listed shares. So if you are transferring up to 23rd July 2024, then the tax is at 15%. On or after 23rd July 2024, tax is at 20%. It has increased. What about LTCG? Two possibilities. If 1,25,000, first of all, you minus from that LTCG, that is an that you can say it's a special exemption given from this LTCG. Then whatever exceeds that, pay tax at 10% if the transfer is up to 23rd July. We have also applied this in yesterday's example. And if the transfer is on or after 23rd July, pay at 12.5%. Clear? Exemptions of 54, 54F and 54 EC. When to take, how to take, why to take. To save capital gains, you should take that. 54 will be house to house. 54F will be any asset other than house, which is long term capital asset, to house. When I am saying house to house, means house is sold. House which is LTCA is sold and investment is done in house. Okay, time limit is there for investments. And then 54 EC, you are selling long term capital asset which is land building, remember that, and investing in NHAI, REC bonds within next 6 months. Ceiling limit 50 lakhs. Ceiling limit for 54 and 54F 10 crores. Quantum of exemption in 54 and 54 EC is long term capital gains or amount invested, whichever is less, but cannot exceed what I told you the limits right now. But in 54F, if you invest entire NSC, then you get exemption of entire LTCG. But if you invest less than NSC, then you get exemption on proportional basis. What is that proportional basis? Long term capital gains multiplied by amount invested divided by net sale consideration. And then there are various special cases in capital gains, like conversion of capital asset into stock in trade. In conversion of capital asset into stock in trade, what we should keep in mind? You are not actually selling. But it is getting taxed in that year in which that stock in trade is actually sold. But the transfer takes place in the year in which there is conversion of capital asset into stock in trade. So benefit of indexation you should take only till that PY in which conversion took place. And in this case, FVC is equal to FMV as on date of conversion. And in the year in which you sell the converted stock in trade, there will be two gains, PGBP and capital gains. To calculate PGBP, you will minus deemed purchase cost. Deemed purchase cost is nothing but FMV as on date of conversion. Remember our example of land. 7 plots were sold. Then compulsory acquisition. Compulsory acquisition by government, transfer takes place in the PY in which it is compulsorily acquired, but it becomes taxed only in that PY in which compensation or part thereof is first received. You can also get enhanced compensation. Enhanced compensation will be taxable in that PY in which it is actually received. And one interesting thing, yes, in this enhanced compensation, COA, COI will be nil. One more interesting thing, you can get interest on compensation or enhanced compensation. This interest will be taxed under the head IFOS. You get deduction of 50%. 50% of that interest received. Clear, all of you? Then, yes. One important thing I want to tell you, if you are selling that listed shares which were acquired prior to 31st Jan 2018, then you are allowed to take cost of acquisition as FMV as on 31st Jan 2018, or actual cost of acquisition, whichever is higher. I hope you remember this point. So these were the important points in CG. Slump sale, I hope you remember. In slump sale, you don't transfer individual assets, you transfer the entire business undertaking for lump sum consideration. That lump sum consideration or FMV of these assets becomes FVC minus expense on transfer. You get NSC minus COA and COI. COA and COI is net worth. Net worth of the undertaking transfer. Net worth is equal to assets minus outside liabilities. And then you will get capital gains. It is short term or long term, depends on period of number of months for which this unit is in existence. If unit is in existence for more than 36 months, long term capital gain. Up to 36 months, short term capital gains. Cost of acquisition and cost of improvement is net worth. Net worth is assets minus liabilities, outside liabilities. Outside liabilities will be taken at book value. Assets will be bifurcated in depreciable and other than depreciable. For depreciable, you will take WDV as per IT Act as on the date of transfer. For other than depreciable, you will take at book value, excluding the effect of revaluation. Understanding? Then, friends, one more point I want to tell you. You know what is that? Immovable property. If it is sold, then what is to be taken as FMV? FMV is very interesting in this case. Not FMV, FVC. What is to be taken as FVC in case of transfer of immovable property? So that will be taken as stamp duty value only if stamp duty value is greater than 110% of actual sale consideration. If it is not exceeding 110%, then you will take actual sale consideration itself as FVC. Got it? But in this case, you know what happens. That's Sarthak's question, Yuvika's question, Shiva's question. If your date of transfer and date of fixing consideration is different, then you take stamp duty value as on date of fixing consideration, provided as on date of fixing the consideration, that is as on date of this agreement, some amount is received by account pay check, bank draft or ECS. Yes, it some amount. So it might be advance, it might be full amount. Doesn't matter. In short, I should be able to prove what? That agreement actually took place, and on the date of agreement we fix the FVC. Is actual consideration. Then friends, you know what happens when depreciable asset is sold. It should be subtracted from opening WDV add additions. But sometimes what happens, this sale proceeds exceed opening WDV and additions. Then it gives rise to short term capital gains. Further, if block of asset ceases to exist, then there will either be short term capital gains or short term capital loss depending on the sale price. This all happens under section 5050. So I hope this is clear to you all. Capital gains. IFOS. Go to IFOS. In IFOS, lottery winnings, card games, horse races, online gaming, betting, gambling is all taxed at flat 30%. Flat 30 means don't take deduction of any expense. And don't take deduction of chapter 6A. Clear? and tax at flat 30. Flat 30 means don't apply slabs. With me, all of you? Then family pension. Family pension gets deduction of 15,000 if you are out of 115 BSc, 25,000 if you are in 115 BSc, or one third of family pension received, whichever is less. So in short, 15,000 slash 25,000 is the most relevant limit. So I told you that 115 BSc, taking 115 BSc is better in for these three cases. 75,000 in 16(1)(a), standard deduction in salaries. Here 25,000 instead of 15,000. And one more place I will discuss with you, 80CCD2, where you get deduction of employers' contribution to NPS to the extent of 14% instead of 10% of salaries. These three places. Then friends, what did we discuss just now? IFOS. We are discussing IFOS. 2 points are done in IFOS. Then you know that any advances received and forfeited on for sale of capital asset on or after 1st April 2014 will be taxed under the head IFOS. If it happens before 1st April 2014, it will be subtracted from cost of acquisition while selling that capital asset. Next, interest on compensation, enhanced compensation. We discussed that it will be taxed under IFOS after deduction of 50%. Clear? Then any royalty, agricultural income from land outside India, then director's remuneration, all these things will be taxed under IFOS. Income from vacant land. What else will be taxed under IFOS? Everything which cannot be taxed in first four heads will be taxed under IFOS. Gifts. Gifts is also taxed under IFOS. Receipts without consideration or for inadequate consideration. If it is gift on occasion of marriage of assessee, not taxable. Other occasion or no occasion, two possibilities. From relatives, not taxable. Other than relatives, two possibilities. In cash, in kind. In cash means monetary terms. It will become fully taxable if gift in cash in aggregate from non-relative exceed rupees 50,000. Fully taxable means if the gift sum total is 51,000, tax will be 51,000. If it is gift in non-monetary terms, means gift in kind, gift of property. What is property first of all? Property means jewelry, drawings, paintings, work of art, bullion, share securities. Yes, this is the meaning of property, sculptures. Property gift will become fully taxable to the extent of its FMV if FMV is exceeding 50,000. But if it is received for inadequate consideration, then FMV minus consideration will get taxable if the difference exceeds 50,000. Okay. Now talking about immovable property. What will happen in immovable property? You have to consider stamp duty value. If stamp duty value exceeds 50,000, it will become taxable to the extent of stamp duty value. If the stamp duty, if it is for inadequate consideration, then you have to consider stamp duty value minus the consideration. If this amount is greater than, if this amount is greater than 50,000 or 10% of actual consideration, whichever is higher, then this amount gets taxed. But friends, gift from relative is not taxable at all. But who are relatives? For individual, relatives are spouse, brother, sisters, parents, grandparents, children, grandchildren, and so on. Parents, grandparents, and so on. Spouse, spouses, parents, spouses, brothers, sisters, and parents, brothers, sisters. Now, whom I have discussed, everyone's spouse. This is relative. So, see, at one point, now you should be able to recollect whole income tax. Now, that will need this much patience. From last 66 minutes, we are revising. Only important points. That is not getting completed. Salaries, HP, PGBP, capital gain, IFOS, residential status. We have revised. Then you have to consider clubbing of income, set off and carry forward of loss. Clubbing of income, minor's income will get clubbed in hands of that parent whosoever's income is higher. Okay, before such clubbing. If you are going for 115 BSc, no exemption of 1500 per annum. But if you are opting out of 115 BSc, for each minor child, you will get exemption of 1500 per annum. I know amount is less, but important from exam perspective. Okay, you can't say it is less amount, will neglect. No. From exam perspective, they will get incorrect answer if you don't take that 1500. If you are opting out of 115 BSc. Remember? Understood? Where minor's income will not be clubbed. If it is earned out of application of own skills and talent, if it is earned by such minor who is suffering from disability of ATU, or it is earned out of manual labor, it will not be clubbed. It will be taxed in hands of minor himself / herself. And you know that if particular person is transferring his house to minor child, he continues to be deemed owner. So it will be taxed in his hands only, income from HP. Even if particular person is transferring house to his spouse without consideration, it also continues to be taxed in hands of transfer itself because he continues to be deemed owner. Any doubt? Then, if one spouse is receiving remuneration from such business where other spouse has substantial interest, then it gets clubbed. Okay, but condition is that that spouse who is getting such remuneration should not be having qualification. Then it gets clubbed. Okay. Few more things I want to tell you, that if spouse earns out of any gifts given by other spouse, then amount gets clubbed. Income amount gets clubbed in the hands of the person who has given the gift. Vaishali Vaibhav. Vaibhav Vaishali example you remember? Yesterday's example also you remember? Ravi. Yes. Ravi Rajesh. Example, Rajesh had given gift to Ravi. Ravi had given that amount as loan. And on that loan, there was some interest that got clubbed in the hands of Rajesh. Remembered? But income on income does not get clubbed. Means Ravi had invested that money in shares and got some capital gain. That did not get clubbed. That got taxed in her own hands. Clear? So after you consider clubbing, then set off and carry forward. Set off intra-head, inter-head, then carry forward. Intra-head, same head. HP loss set off against HP income. PGBP loss set off against PGBP. It is called as intra-head. But intra-head has got restriction. What restrictions? Loss from specified business can be set off only against income from specified business. Loss from speculation business can be set off only against income from speculation business. Long-term capital loss can be set off only against long-term capital gains. Loss from owning and maintaining racehorse can be set off only against income from owning and maintaining racehorse. Then inter-head set off has got some restrictions. These 4 restrictions which I discussed just now, plus loss from HP can be set off against other head only to the extent of 2 lakhs. Business loss cannot be set off against salary income. Any type of short-term capital loss cannot be set off against other heads of income. So 7 restrictions in inter-head. And if interhead is also not possible, you carry forward. Carry forward losses can be set off only against same heads except for unabsorbed depreciation. It can be set off against any head except salaries. Further, to carry forward, you need to always file ITR within due date of 139(1) except for unabsorbed depreciation and HP loss. They can be carried forward even if you don't file ITR within due date of 139(1). That's it. Now you get GTI. Then take deductions of section 80C to 80U, that is chapter 6A. Usually not allowed if you are in 115 BAC. In short, to take these deductions, you should be out of 115 BAC. But 3 are allowed. Some deductions are allowed even if you are in 115 BAC. 80 JJAA and 80 CCD2. These two are allowed. Now, deductions, families, C, CCC, CCD, 80C, 80CCC, 80CCD. I will neglect saying 80. So, C, CCC, CCD, ceiling limit 1,50,000. But 80CCD 1B, additional limit 50,000. Contribution to NPS. And 80CCD 2, deduction is 14% of salary or 10% of salary, depending on whether you are in 115 BSc or out of 115 BSc respectively. And of course, when you are central government employee, always 14% of salary. This is 80CCD 2, employer's contribution, which first gets added in GTI, then deduction is given. Friends, then 80D, mediclaim, 25,000, 50,000. And preventive health checkup, inner ceiling limit 5,000. When I said 25, 50, 50 is for senior citizen. And you know, for me, spouse, dependent children, an additional limit for parents. But if senior citizen does not have mediclaim, then for actual medical expenditure incurred, or 50,000, whichever is lower. Mediclaim has to be compulsorily paid in mode other than cash, but preventive health checkup can be paid in cash. 80DD, disable dependent, flat deduction, 75,000, 1,25,000. 1,25,000 when severely disabled. Dependent's definition is there. You know who? Spouse, children, brothers, sisters, parents. Dependent. Then friends, 80DDB, for specified diseases, 40,000, 1 lakh, ceiling limits. 1 lakh when the treatment is taken for senior citizen. 80E, EE, EEA, EEB, interests. Education loan, E, EE, EEA, housing loans with some specific conditions. EEB, electric vehicle. Friends, E, no ceiling limit. EE, remember EE? EE, the sanction should be between 16-17 financial year for the house. The value of the house should not exceed 50 lakhs. 50 lakhs. The loan should not exceed 45 lakhs. These conditions are there. Loan should not exceed 35 lakhs. My bad. Loan should not exceed 35 lakhs. Remember. Then ceiling limit is 50,000. 50 ceiling limit? Yes. 80 EEA. Now go to 80 EEA. Same house, but stamp duty value should not exceed 45 lakhs. No condition of loan amount. Sanction should be between 1st April 19 to 31st March 22. Ceiling limit is 1,50,000. Remember, 1,50,000 is ceiling limit of 80 EEA. 80 EB, E-vehicle. Ceiling limit 1,50,000. Sanction 1 April 2019 to 31st March 2023. That's it. Then 80G, donation. Donation, 4 categories. 1, 2 without qualifying limit. 3, 4 with qualifying limit. In 1, 100%, 24 funds. In 2, 50%, 1 fund, Prime Minister Dot Relief Fund. 3, 100%, Family Planning and Olympic Association. Qualifying limit is there. 4, 50% to any charitable trust, but should be registered for 80G purpose, that charitable trust. Friends, qualifying limit is 10% of adjusted GTI. Again, qualifying limit is 10% of adjusted GTI. What is adjusted GTI? GTI minus deductions of 80C to 80U except 80G and minus LTCG minus STCG of 111A. What do you do? Calculate adjusted GTI. First use it for 100% third category, category 3. Then remaining you use for category 4. Remember question of Shiva. Clear? But donation in excess of 2000 cannot be in cash. 80G is allowed for all assessees. Then 80GG, rent paid. But I'll 80GG I'll revise afterwards, after 2 minutes. GGA, GGB, GGC, GGA, Scientific Research Association, you're donating to them. Condition is that you should not be able to claim deduction of 35. Then 80 GGB and GGC, donation to political parties. GGB is for companies, GGC is for other than companies. No amount of deduction will be allowed if you are donating in cash, especially 80 GGB and GGC. Even that advertisement amount you have paid in journal of political parties, that will be allowed as deduction here. If that local authority is funded by political parties, sorry, if AJP, artificial juridical person, is funded by local authorities, then they can be able to claim deduction of 80 GGC. Then 80 GG, rent paid. Rent paid is allowed as deduction if you are not able to claim HRA exemption, or you are self-employed and you are not having house where in that locality where you are usually employed or usual place of businesses, and your minor also should not have house and your spouse also should not have house in that locality, then you are getting deduction of 80 GG, rent paid minus 10% of adjusted gross total income or 25% of adjusted gross total income, or rupees 5000 per month, the golden amount, 60,000 total. Adjusted GTI is equal to GTI minus 80C to 80U except 80GG. That's it. Then go ahead, 80 TTA, 80 TTB, 80 TTA, TTB, QQB, RRB. These 4 deductions are very different. They are based on incomes. TTA, interest on savings, one of very favorite of institute, but you should not be senior citizen. 80 TTB, interest on any deposits for senior citizen, resident senior citizen. Limit of 80 TTA 10,000, 80 TTB 50,000. Clear? Go ahead. 80 QQB, 80 RRB, royalty, QQB, royalty for authors other than of textbooks. If royalty is received from foreign, it should be remitted to India within 6 months from the end of the PY. And RRB, again royalty on patents. But by the way, 80 QQB has inner ceiling limit of 15% of value of books, and 80 QQB, 80 RRB both have separate ceiling limits of 3 lakhs per annum. And lastly, 80U, 80U means disabled person earning. If he is not having severe disability, then deduction is to the extent of, if he is not having severe disability, 75,000. Severe disability, 1,25,000. Always you know severe disability means 80% or more. This is for 80U also and 80DD also. Disable dependent. 80JJAA for those individuals who are engaged, individuals or any assessees engaged in business having tax audit and employing additional employees. Deduction will be allowed to the extent of additional employee cost into 30%. 30% for first year, 30% for second year, 30% for third year. Additional employee cost. Who are the additional employees? Additional employees are whose monthly emolument is not exceeding 25,000. Second, who are participating in RPF and employed for at least 240 days. And if it's a seasonal industry like footwear or apparel, then this 240 days is replaced by 150 days. Clear? This is your 80 JJAA. Allowed even if you are out of 115 BSc or you are in 115 BSc. Fantastic. Now you get total income. On that total income you calculate tax. How? By applying special rates which we discussed. 30%, 12.5%, 15%, 20%. In short, which we discussed for STCG, LTCG and casual incomes. Balance income, apply slabs. Because I am mainly discussing for individuals. What slabs? You may be in 115 BSc, you may be out of 115 BSc. If you are in 115 BSc, 0 to 3 lakhs, no tax, 3 lakh to 7 lakhs, 5%, 7 lakh to 10 lakh, 10%, 10 lakh to 12 lakh, 15%, 15 lakh to 12 lakh to 15 lakhs, 20%, above 15 lakhs, 30%. Now, if you are out of 115 BSc, depends on the age of the assessee. If he is resident super senior citizen, 0 to 5 lakhs, no tax. If he is resident senior citizen, 0 to 3 lakhs, no tax. If he is others means non-resident, or others means resident whose age is less than 60, then 0 to 2.5 lakhs, no tax. By the way, this age is to be checked in the PY, not AY. Age is to be checked in PY. Now, other slabs, 2.5 lakh to 5 lakh, 5%, 5 lakh to 10 lakh, 20%, above 10 lakhs, 30%. But thing to be kept in mind is, of course, if I am senior citizen, then 3 to 5, 5%, 5 to 10 remains same, and above 10 remains same, 30%. And if I am resident super senior citizen, 0 to 5, no tax, 5 to 10 remains same, above 10 is same, 30%. Rebate, consider rebate in 115 BSc if your total income is not exceeding 7 lakhs. Then take rebate. Rebate to the extent of tax payable or 25,000, whichever is less. In this rebate, there is a marginal relief also. Consider that also. Only of 115 BSc rebate, there is a marginal relief. Now, other than 115, you are out of 115 BSc. Rebate of 87 is to be considered if your total income is not exceeding 5 lakhs. Rebate is to the extent of amount of tax payable or 12,500, whichever is lower. Clear, no? Then you may be attracted to surcharge. Surcharge gets attracted if you are in 115 BSc. First, let's discuss. Surcharge gets attracted if your total income is between 50 lakh to 1 CR at 10%, 1 CR to 2 CR at 15%, above 2 CR 25%. But what you have to consider is, yes, first let me discuss that surcharge also. That means when you are out of 115 BSc, one thing gets added, 2 CR to 5 CR. 2 CR to 5 CR, it is at 25%. Above 5 CR, it is at 37%. Well done, well done. But point is, STCG of 111A, LTCG of 112A, as well as dividend, these three things should be excluded means your surcharge on this will be restricted to 15%, and you should check your total income excluding this surcharge and then decide what is the surcharge rate. Once you have got that, what you should do now? You should take subtotal and you should add 4% health and education cess. Your total income was there na? That was rounded off to nearest of 10 under section 288A. Now tax liability will be rounded off to nearest of 10 under 288B. But you might have some advance tax and TDS. See na, TDS, TCS, advance tax, TDS, TCS. Advance tax gets applied if your advance tax liability is 10,000 or more. Advance tax liability means total tax liability minus TDS minus TCS. But it is not applicable for resident senior citizen who is not having PGBP. See, everything is important. Once you keep the book aside, close your mind, close your eyes, revise whole syllabus like this. Then you have to give exam. Revise your whole, this way you should be able to do. Then you are confident that one day before exam you don't have to touch the books. One day before the exam, even if I leave you for movie, then also you should be comfortable. I am not saying you should go for movie. I am saying you should come in that state of mind that one day before exam you, why I am telling you, because one day before exam you might have fever. Then you cannot lose the exam because you have worked hard for 6 months. You are getting my point. So you should be prepared in such a level that you are not dependent on one day before exam. Please. That is last thing. That one day before exam, your fate depends on that. Well prepared in advance. Okay. So advance tax. Slabs, installments. 15, 45, 75, 100. 15 June, 15 September, 15 December, 15th March of the PY. Then talking about if they don't pay, if there is a shortfall, 234C interest. But for attracting 234C in first and second installment, you should not have paid 12% slash 36%. If you have not paid that, then advance tax interest of 234C gets applied. Whenever 234C gets applied for first 3 quarters, then it is shortfall multiplied by 1% into 3 months. But for last, it is into 1 month. Now 234B, when 234B applies, 234B applies if you have not paid at least 90% of advance tax payable by 31st March. If you have not paid at least 90%, then it gets applicable. It gets applicable from 1st April till the date of actual payment. Interest is at 1% per month or part of the month for which the delay continues. One important thing I forgot to tell you in 234C right now, if there is any winning from lotteries, such casual incomes or capital gains, then effect of that should be considered from next installment. Means if you have won lottery slash you have LTCG in month of December, say on December 5th, then its effect will come only in the last 2 installments because first 2 installments are done. We have also solved one practice question on this. Then going ahead, 234A, interest for delay in filing of ITR. So if there is any delay beyond the due date of filing ITR, then on that delay, for that delay you calculate interest at 1% per month or part of the month. This will be calculated on the amount of tax which has remained payable on 31st of March. This is 234A. Clear? Friends, then TDS. Because when you do advance tax and TDS minus from total tax liability, you get net tax payable. And getting that net tax payable, you should pay that tax and you should file ITR. Then only it will be considered your assessment is done. Getting it? If you have advance tax TDS which is more, you will get refund. Okay? Remember, TDS provisions. We can't skip that. TDS. Chalo, revise. Only one thing is pending for revision in the whole thing, TDS. TDS important sections. 192 salaries. So I'll tell you sections for businesses. 192, 194A interest other than interest on securities. 194C, C for contractor. 194H agent. 194I rent. 194J professional fees. Salaries, tax payable by employees equal to tax to be deducted at source by any employer. 194A interest other than interest on securities. If I am paying interest more than 5,000, then TDS has to be done at 10%. But if bank is paying, then they should check threshold limit of 40,000. But if bank is paying to resident senior citizen, limit to be checked is 50,000. Wonderful. This is 194A. 194C, C for contractor. Contractor threshold limit, single payment 30,000, aggregate of payments during the year 1 lakh. Are you getting it? Then what are the rates of TDS here? 2% slash 1%. 1% if I am paying to individual or HUL. 2% if I am paying to others. Good? So far so good? Then 194 I, H, okay, H, first H. H is what? Commission. Mind you, whatever sections I am discussing, 194A, 194C, 194H, 194I, 194J, for all of this, who is the payer? Any person other than individual or HUF. But individual HUF will also have to do TDS if in the last year their turnover in business exceeded 1 CR slash in profession exceeded 50 lakhs. Now, coming back to 194H, if commission is exceeding rupees 15,000 during the year, the TDS is at 5%, but with effect from 1st October 2024, it is at 2%. Then 194I, rent, 2 lakh 40,000 is the threshold limit. In all these cases, TDS is to be done at the time of credit to the account of the payee or at the time of making payment, whichever is earlier. Coming back to 194I, if you are paying for rent for land building, TDS is at 10%. If you are paying for any asset, 2%. J. Coming to J, professional fees, fees for technical services, royalty, director's remuneration, non-compete fees. For each of them, separate threshold limit of rupees 30,000 per annum, except for director's remuneration, no threshold limit. Clear? The rate of TDS is 10%, but if it is for call center, 2%. Yes. And royalty paid to cinema halls, again 2%. Clear? So far so good. Then coming to some unusual provisions in TDS. Unusual means every businessman will not use it, or rather businessman won't have to use it. It's for others. 194 IA. What is IA? See, while revision for businessman, you can revise 193 also, interest on securities, and 194 also, in TDS on dividends. Okay, friends, remember 194I, if I am buying property where the consideration is or stamp duty value is 50 lakhs or more, then I have to do TDS at 1%. Remember 194I, I may not have TAN in that case, still I have to do TDS. Then 194IB, if I am paying rent in excess of rupees 50,000 per month, then I have to do TDS at 5% till 30th September. But if I am deducting on or after 1st October, it is 2%. And it has to be done, TDS has to be done only once in a year, in the last month of the PY or at the time of vacating the premises, as the case may be. Then friends, 194Q, do you remember 194Q, TDS on goods? This will be applicable only if TCS, rather TDS will be applicable even if TCS on goods is applicable of 206C1H. So what is 194Q? 194Q is applicable if that buyer has a turnover in excess of 10 crores and buyer is buying goods in excess of rupees 50 lakhs from that particular seller during a financial year. Then TDS is applicable at 0.1% of amount which is paid in excess of 50 lakhs. Clear? But if that opposite party does not give PAN, then this gets replaced by 1%. 5. TCS gets replaced by 1, this gets replaced by 5%. TCS of 206C1H gets replaced by 1%. Not this gets replaced by 5%. 194N, cash withdrawals. Do you remember cash withdrawals? If non-defaulter is withdrawing cash in excess of 1 CR, then TDS will be at 2% in excess of this 1 CR. Bank will do this TDS while giving this cash to you. In a year, you are exceeding 1 CR. Whatever exceeds 1 CR, on that you have to do TDS of 2%. But if you are defaulter means you have not filed ITR for last 3 years and due date of filing ITR is done with, then what to do? Then limit applicable will be 20 lakhs. Between 20 lakhs to 1 CR, it will happen at 2%. Above 1 CR, it will happen at 5%. But if the person who is withdrawing is cooperative society, then the 1 CR will be replaced by 3 CR. Otherwise, everything will remain same. We have done one example with 10 or 12 points. I hope you remember that example. First 6 were non-defaulters. Next 4 were defaulters. Remember that. See our examples, if you remember, classic example. Not because I have given them. I have taken them from ICI only. Who else? So classic examples. If you remember that, on that basis, whole paper you can solve. Whole income tax you can understand. 194M. You remember M? I hope you remember M. What is M? That excessive payments, that is in excess of 50 lakhs, is done towards contract, towards professional fees, towards commission. So in short, 194C, 194H, 194J are not applicable. Such assets is making payment in excess of 50 lakhs. Mostly these are personal payments. Then the TDS will apply. If the payment is up to 30th September, then it will be at 5%. With effect from 1st October, it will be at 2%. This is 194M. Friends, then TCS on motor car, you remember? If the motor car value is exceeding 10 lakhs, TCS will be at 1% of the entire amount. And then 206C1H, so you know, TCS, when I am selling goods, that will become applicable only if TDS is not applicable. And percentage is same like TDS, 0.1. If PAN is not given, 1. If PAN is not given by buyer, then 1. And last thing I want to revise, which I forgot while revising IFOS, that is newly introduced dividend of 222F. 222F, that is on buyback of shares. If shares are bought back, then whatever amount shareholder is receiving, whatever amount shareholder is receiving on buyback, that gets taxed. Under the head IFOS, income from other sources. Entire amount. Mind you, entire amount. And whatever purchase price was there of the shares bought back by company, that gets as a deduction under the head capital gains. So there will be a capital loss. This whole thing will happen on or after 1st October 2024, because before that companies used to pay tax on buyback under section 115 QA at 20% plus compulsory surcharge of 12% plus 4% health and education cess. So friends, this way whatever points, important points I could imagine, I have completed in exactly 100 minutes. So I would like to complete my 100 minutes by wishing you all the very best. Please do comment how you found this. Don't laugh. Those who are sitting here should give feedback about how you found the entire classes in the comments to this video. And those who are watching across India, especially I know students from South would be watching, because I did not utter a single Hindi word. So this is especially for my South Indian students. So please do subscribe to the channel, hit the bell icon, make this channel viral, make this video viral, because it is important. Passing in tax should become viral. That's why this video should become viral. You put headphones for 101 minutes, listen to this. First, while listening, you may have to listen at 0.5. YouTube has given you facility of 0.5, 0.75, 1, 1.25, 1.5, 2. Use this facility to the best possible extent. How? First, while revising, first you do self-revision. After self-revision, what you do? You listen to this at 0.5. Once you listen at 0.5, next time you go at 1, next time you go at 1.5, next time you go at 2, then you don't listen, then you recollect all the provisions. See friends, I have been teaching from past 15-16 years. One basic problem that comes in income tax is, sir, we understand income tax, fantastic. When you teach, we find it makhan, easy, butter, no problem. When we sit for revising, if we keep on revising on daily basis, so again we find it easy. But somehow we'll manage that also. But what is to be done one day before exam? How the subject should be retained at a time? So this is the solution for that. Already we have solution for GST. We have concised whole GST in 70 minutes. I will give you that video also. And this is whole income tax in about 100 minutes. Okay. So make maximum use of it. Thank you so much for the love. Bye bye. Take care. Wishing you all the best.